We can start now.
No, just a minute. Jeet's audio, please check. I think CRISM8 is coming near his face. Logo. Jeet sir's video is fine. Just check.
I'm sorry, who's this?
This is Nitya here. Jeet, hello.
Nitya ma'am. Yeah, I see my video quite clearly.
Okay, I saw the logo of CRISM8 nearby your. Now I think.
I think we can start, I think.
Yes, ma'am.
Pasha, ready? I'll check live.
Assistant Professor Ruchika Bassi welcome all the participants for a national webinar on risk mitigation and crisis management organized by the Management Association of Department of Management Studies of Pillai College of Arts, Commerce and Science, New Panvel. Pillai College of Arts, Commerce and Science has risen from a simple beginning in 1998 to be the most popular institution catering successfully to the needs of rural, urban, and global students with 8 undergraduate and 4 postgraduate programs to over 4,000 students. UGC has conferred autonomous status to Pillai College of Arts, Commerce and Science in the academic year 2019-20. Under an autonomous status, the institution aims at bridging the gap between academics and industry by introducing industry-relevant courses and diploma programs, which will give wider educational choices to the students and add to their employability quotient. Management Association of Department of Management Studies organizes various seminars throughout the year. And the main highlight of Management Association is the fest named Genesis, which is a 3-day event comprising of seminars and management-based games. The fest aims at educating and improving the management skills through seminars. It also showcases a stage to students wherein they can show their business ideas and test their knowledge through various management games. The three major specialization of BMS, that is marketing, HR, and finance, are explored in a fun and creative way. The fest gives an opportunity to create memories with people, not just from their own stream, but with others as well as. So now I would like to invite Management Association in charge, Mrs. Sharavati Jayarajan, to introduce you to today's speaker. Over to you, Sharavati, madam.
Thank you, Ruchika madam. Good afternoon to all. Respected principal, vice principal, resource speaker, beloved faculty members, and my dear students. A warm welcome to everyone. I, Professor Sharavati Jayarajan, in charge of Management Association, Pillai College of Arts, Commerce and Science, welcome you all to the national webinar on risk mitigation and crisis management. I would like to extend our sincere gratitude to our guest speaker of the day, Mr. Jeet Mukherjee, for accepting our invitation. Now, I take the privilege to introduce the guest speaker. Mr. Jeet Mukherjee is a security consultant with over 12 years of experience. He is a member of the Chartered International Institute for Security and Crisis Management and the International Society of crime prevention practitioners. He has been recognized by corporates like Carlson Rezidor Group and CBRE at India and APAC level. As the CEO of CRISM8 Solutions Private Limited, he is dedicated to support organizations with risk-based solutions in the real estate and integrated facilities management environment. So, we are honored to have you with us today. Welcome once again, sir. Now, I request our resource speaker, Mr. Jeet Mukherjee, to share his valuable inputs. Over to you, sir.
First of all, I'm delighted, ma'am. Thank you so much to all of you for giving me this opportunity to be able to speak to such a bright group. Always, like I said, it's an awesome opportunity to be able to speak to students, the bright minds. I can't really convey my thanks in words. It's an awesome opportunity indeed. It was too much for an introduction. It was like, what should I say to this? It was way too much, ma'am. Thank you so much for your kind words. I'm so happy for this. Okay, so do I have the permission to share my screen over here? Fantastic. So, dear all, we will talk on risk mitigation, crisis management. Now, it's risk mitigation. When we talk of risk and crisis, I'll prefer to talk on risk and crisis more of at an individual level and then incorporate that into an organizational level. When you talk of crisis again, same concept. Dwight David Eisenhower had mentioned plans are nothing, planning is everything. The reason I love this word is because we always think we plan, things go for a toss, what happens? No, but then the end result is we still plan continuously because the same plan might be something we actually improvise on, but the idea, the culture of planning way in advance is more important. So a plan is, there's a core difference between a plan versus planning. Planning is more of an attitude. It's more of, the way you approach any situation. You think in advance, you resource it out to other people. If you do not know, you think of it. Whereas a plan is more of something you draw out today. So that might fail, but of course, the attitude towards think in advance is everything basically. And if we talk on risk mitigation, crisis management, predominantly the whole idea comes on the idea that we need to constantly plan for what comes ahead. Okay, now when I talk on risk, what's the idea which comes to mind when we think of risk? It's uncertainty. What's going to happen tomorrow? It's going to be right, it's going to be wrong. May lead to losses, may lead to a crisis. Should not be confused with threats and hazards, because a threat and hazards, and now I'm trying to convert this into as simple as a concept, because there's no point using jargon terms because that might not even convey the actual message. The whole idea is to understand that uncertainty is basically the outcome, the consequence of an uncertainty is what we call as a risk. And a threat is a different concept. A hazard is a different concept. Now, so if I say like water on the floor, and we'll talk on this later, a water on the floor is a hazard. I might slip on it, I might fall on it. When we actually talk of a risk, I might think, okay, if I'm leaving my apartment and shifting over to a different country or a different city for a year, then by the time I come back, the water's going to dry up. So there's no question of someone actually slipping and falling over it. So that is something we'll talk more on this in the upcoming presentation. So what I want to tell people is risk management is an essential concept. While it should not induce phobia, we should not think something necessarily wrong happening. This is precisely the way the concept of risk is evolving, and people are thinking. And indeed, the first generation of risk management, people used to think risk as a hazard, as a threat, intent to harm someone. Oh, that's a risk. No, no, no. It is not that. It is something we'll learn. Risk can be positive also. We'll learn that when we study speculative risk. I'll proceed further. You know, so in risk, we classify risk. So before we move into risk management, crisis management, the concepts of that, we need to understand what risk is all about. So one is pure risk, which is where it's a hazard risk. There's no possibility of a gain. We think of loss of life or property from maybe a natural cause like a fire, earthquake, or a flood, or it could be man-made, unintentional, like an operational mistake in a procedure or practice. So I've made a mistake, not intended, where something goes wrong, or intended, like a theft, embezzlement, arson, terrorism. See, the concept of mitigating pure risks was in fact mentioned in the Hammurabi's Code in 1700 BCE. Now, and I want to speak quickly on this just to, appraise the group. It's so interesting when I study the history of risk academically. So basically what used to happen is there used to be boats where they would carry cotton fiber, and that they used to go over the river. Now, there would be pirates, there would be natural risk, like, say, for example, a storm in the ocean that would sink the boat. Hammurabi, in fact, did two things. One is punitive action. He kind of introduced punitive action. Second is he introduced the concept of insurance, wherein the idea was this, and that's the prehistoric, no, this is not exactly prehistoric, the old concept of insurance, wherein he said, okay, when you buy your materials, you can actually get paid from someone else. If your boat sinks, you don't have to pay back. Only if you successfully reach, you pay back. So that is like, that tells us what we are talking of is not something we are thinking today. It has been thought way back 1700 BCE, and that's a recorded history. We do not know. It may have been prehistorically truly that we were actually thinking of risk mitigation. Now, typically, the reason I'm saying this is involuntary is because unless we are looking for an insurance fraud or something, we would not want a fire. So this list typically in pure risk includes the elements which are only causing a loss if it happens. If you see all the items listed over here, you would see if it hits us, there's always a loss. There's no gain if it doesn't hit us. While what's more interesting is the modern purview of risk, that's speculative risk. Risk is seen as a gain or an outcome possibility. So basically, strategic decision, say for example, if I'm opening a new plant, launching a new product in business, shifting to a different city or location. So risk is not only about personal life or business. We've got to experiment that in terms of both the aspects. If you see now, even changing from job to business, there's a risk. In a job, typically you have a salary coming in the first of the month. When you move into a business, you're thinking, oh, okay, I may have a possibility to earn much more, but I don't have that guarantee salary is going to hit me first of the month. But then, that's the whole idea of life. Stagnation, we'll talk on this again much later in this, that, the whole idea of risk has changed. Perception of risk has changed, brought towards more of a speculation when you think there's a possibility of a gain or a loss, and make an investment plan for future. Once again, again, stock investments can, equity, debt, things, market, that's not in our control, but that's a risk, but that's not necessarily a loss. Can make us in a profitable situation also. But then what we should understand is, we always talk about strategize, plan it up. It doesn't mean no risk, because the whole idea of certainty in life is quite elusive. There's nothing guaranteed. And, it's a very generic statement used in the academic environment to study risk. And I think it's more applicable in a practical environment also, where people, risk professionals, if some of you come up to become risk professionals, and without understanding also, we always handle risk. Sometimes we don't realize we are, but we always are. So it certainly means we have to be prepared for it. That now, what happens when we work in an environment is our behavior, attitude towards risk changes. Now, in risk management, we typically divide a risk taker, the attitude of the risk taker, in 3 different categories. So one is a risk seeker, typically the gambler type. I think, okay, I'll put so much of investment into something, and I know I can lose, but then I can gain also. So the risk seeker type is that entity who's ready to accept a higher loss while aiming for a gain. Risk averse is quite the opposite, who have a fear for uncertainty. Now, technically, if I talk to my mother on investment, she'll say, no, I am happy with my money in my bank account. I don't want to go into investment because there's a risk involved. Now, see, the point is, risk neutral is when someone takes a certain degree of risk because they accept some loss while hoping for some gain. Now, that's the correct way, because understand, not taking a risk is not worth it, because life involves a certain degree of risk in itself, be it you talk for business, be it of life. So since we see risk as an outcome of a change, it's a consequence of uncertainty, as we see in this page. It's basically every change brings some degree of uncertainty. Now, the point is, now, as students, if I ask you, would you be happy if I tell you, you have to be in this exact situation, you won't be finishing your courses for the rest of your life, just be happy around? No, you say no, maybe no, I want to finish it off, I want to proceed. So change is something that we need. It's basically the cause of innovation, and that's exactly where risk is welcomed. Now, hence, this attitude towards risk is very important, because when we study organizational risks, we'll see organization that has come up, something we'll study later as risk appetite, for that changes also. A person who would say today, this is okay for me to take, that same person might say tomorrow, no, it's a big risk. So that's all that behavioral type we think of. Now, since we studied, had a core understanding of risk broadly classified, we'll go into how to even analyze a risk. So when we think of analyzing risk, see, I'm trying to keep it as, this presentation will be, like I'll say later also, it's going to be kind of, because risk management is quite a wide subject. There are quite a few categories of risk, starting from physical security to health and safety to investment to, risks which are diversifiable, non-diversifiable, government risks, and, we can think of intangible and tangible risks, like, say, for example, reputation is not tangible. You can't count in a finite value. So I'm trying to keep this as simple because the whole idea is to give a basic concept of risk management and proceed further towards deeper discussions. So I'll try to keep it mile wide and knee deep. Now, when we talk of risk in general, everybody certainly seems to have a perception of risk. Now, you talk to your neighbor, you talk to your friends, everybody seems to understand what risk is all about. But then the question is, half the time, through experience academically and through work experience, what we understand is people do not know what is to be protected. So the question comes, what are we trying to protect? So, like when we say people, people in what sense? Are we talking of well being, or are we talking of an actual security and safety risk to people? So, say, for example, a company issues a health insurance for an employee, that's still for people because it's a human asset, as we call it. So, that's not necessarily a risk they are facing in workplace. But then, if you see in a broader sense, a key employee has a health issue, an uncertainty, and that employee doesn't come down, then the organization might face a loss for it also. Now, so you've got to think of things in general: assets, tangible, intangible. You could have physical properties. Typically when we talk of assets, we also think of what are we talking of, tangible aspects, intangible aspects, as we'll go deeper down. you know uh, like say for example, when we talk of tangible assets, current assets, cash, marketing, tangible assets, we can talk of intangible assets again. We can talk of fixed assets, property, equipment. Then we go into intangible assets, which could be maybe non-physical, maybe a trade secret, maybe a trademark, maybe a copyright, maybe a patent, maybe some legal agreement, something, maybe a confidential document, which all could be intangible. That all could actually be something that you're trying to protect, because the whole idea of risk analysis is based on the first step, that what am I trying to protect? Determining then the likelihood of occurrence. Now, when I determine the likelihood of occurrence of a risk, so of something materializing, I typically see the historical data. I look at it. So that's the first step I look at. Now, say for example, if I'm talking to an employee who's traveling down through a certain road from home to office, I'll observe the road and say, hey, when I look at this accident data, I see in the past 5 years, there has been so many accidents. So you better try to work from home, or maybe if you have to drive down, drive very slowly, maybe take an alternate route. So that's historical data. Second is predictive analysis. Sometimes just because something has not happened before, nothing that materialized before, doesn't necessarily mean it will not happen. So I might have to think predictively, and I think, okay, there's a possibility of that to happen. Now, this presentation doesn't include this, but then we will, discuss further towards the later end, wherein we talk of the whole idea of vulnerability and threat perception, wherein, where we think, yes, just because something hasn't happened before doesn't necessarily mean it cannot happen before. And that's the, so it's basically a combination, which lets us think of a likelihood. Now, the next question that comes up is, okay, if there's a likelihood of occurrence, then what's the severity? So, say, for example, if I am um, in a road accident, one thing. If I'm in a flight accident, one thing. Or if I'm in a road accident, what is the maximum that can happen to me? Now, this could be seen in terms of business, in terms of if I'm making this investment into taking over, say, for example, a different business, or if I'm launching a product, Now, what could be possibly happening in terms of an impact and how much would actually affect me? And that could again be tangible, intangible. I could say, okay, I'm establishing a new factory, which will do so and so. If the factory burns down because of a arson attack or something, then I'm having a loss of so and so. But then um, it could also mean that same factory which is producing so and so products for me is not able to produce that, so I might lose brand value. There could be people working in that factory whose families could be suffering. Now, hence, when you calculate risk, it's almost impossible to actually quantify. Although, as risk assessors, we try to quantify things in terms of absolute value, like X amount of money would be the net loss. But sometimes it's practically impossible to quantify things. So what we do is qualitative and quantitative. We say like, oh, this will happen, but this cannot be put in terms of so and so rupees, dollars, pounds, and whatever. It's like, no quantification is possible. But then this will actually affect you. So we typically, a well-balanced risk analysis report actually incorporates both the factors. Typically, reputational risk is one risk which you say is intangible. Reputation is brand value. So if I am responsible for doing something and that goes for a toss, it is not exactly I can think, okay, it's a loss of so and so dollars, so and so pounds or rupees, but then it's still a big loss. Once we analyze risk, we come into risk mitigation. The first step is, obviously, when we know risk, you want to avoid that risk. So if someone tells me, oh, that's a big risk, we want to avoid it. So avoiding obvious causes, because risk is avoided by avoiding the cause, because risk is technically an outcome, if you remember. Now, so avoiding the obvious causes. Now, how do we do it practically? It's like designing policies to foresee and avoid a high risk situation, or maybe a design review. Say, for example, I'm launching a product and I'm thinking, okay, now I'm like, is it going to work well? No, maybe not. So maybe let me do a review way beyond before I launch it actually. Or if I'm taking a contract, uh, then let me understand. Or this could be seen as, if I'm employing someone, I do not know the past experience of that employee. Maybe that entity had done something wrong. So that due diligence also overall can tell me the process, like, is it worth it? Is it not? Um, Adopting safe work practices, maybe that can help me avoid a certain degree of risk. But now that I've avoided, I practically know, hey, whatever I could avoid as a risk, I've actually avoided. But then I do need to accept the fact that, some risk will still remain. In a personal life, I can tell, like, if I absolutely do not go out of the house, I don't even get out of my bed, like, avoid everything, don't even move, I can still technically die from a heart attack on my bed also. So risk still remains. That's what we call as risk acceptance, because there's nothing called certainty. So bottom line, risk always remains. So what we think of is, after, like, even after all the checks. Now, say for example, last time we talked of design review, checking products and everything before releasing into the market. But no matter, it may have worked fantastic in my lab, customer uses, maybe in his or her situation, fails. Again, loss of reputation. I might use all my strategies, which you'll see later, but then we need to understand this basically. That cannot go, like, completely taken away. That cannot be mitigated entirely. That's something I need to absorb. And such risks need to be retained with us as an individual, as a corporate. It needs to be retained. And that's precisely what we define as a risk appetite. Now, once we have understood that we have to accept something, what we typically try to do is like, okay, less I accept, The less I absorb, the better it is. So we go for the next step, as in try to reduce what we could not avoid, and what we have to accept. We try to reduce that. So we try to minimize the loss impact. So maybe in terms of impact and frequency. Now what we do is install initiate certain measures, maybe have a governance or a control measure, a protocol. What's interesting, as I say, like pooling and spreading is typically, say for example, if I have a factory which produces certain materials, some raw materials come from a plant which are maybe in earthquake prone area. Now I think, okay, if that's an earthquake prone area, what I could do is maybe I have a few of the other plants in areas which are not earthquake prone. So I'm kind of those have a similar profile. They all are providing me the raw materials, while I'm also spreading, because earthquake hits one area, it not gonna it certainly won't be hitting all the other areas at the same time. So basically conceptualizing, understanding that the same pattern, if spreaded. Insurance is somewhat, we can see it in a similar sense. In a sense, if we say, for example, everybody has life insurance in the world at the same time with the same company in this aspect, but then everybody will not die at the same time. So, or maybe think of it key, accidental death is what I'm talking of, not natural death in this case. So now what happens is, when we are insuring, we are paying a certain premium, everybody's paying. So here, everybody from the same pattern, you've pooled. What you've done is you've spread it. Now one person unfortunately passes away, then that collected money could be used to share this. Now, spreading is somewhat a slightly different concept over here. So basically, when we think from insurance perspective, also when the risk is pretty wide. Now, think of a very massive exposure unit. Say, for example, a flight like an aircraft. Now it could be that expensive that one insurance company might be thinking of, no, it's way too much. If an accident happens, we can't give an insurance, or maybe the premium for the insurance becomes way too high. So hence the spreading concept is applied, wherein they could think, okay, I insure some part of it, you insure some part of it, and this and this and this. Or the insurance company themselves might be coming to a contract wherein they say, oh, okay, so we have our pooling combined together, and thereby, so now I have so many people, so many entities insured under me. You have so many. So this is the concept of pooling and spreading, not only necessarily applied in insurance. I just use that as an example. The whole idea is to create a big pool of people with similar requirement, or entities with similar requirement, and then spreading out the risk amongst them to ensure there's a net achievement in sense of an overall reduction in case of a loss event is there. So you kind of try to reduce the losses in general. Then it's transference. Shifting the burden on someone else's, that would have been amazing. Like, so basically, if I have done, I'm in a situation wherein I cannot completely take off the burden myself, I'm shifting the burden to someone else. I may be in the process of doing so, I'm losing some control, but then it would be great if I feel, okay, I'm not entirely facing the brunt of the incident that has happened. So now insurance is certainly insurance indemnities. These are examples of an effort to transfer a certain degree. So I have a house which has burnt down, or I die. Now I don't earn anymore. Who's going to support my family? So that now I have transferred. Now the emotional risk, so it's not the emotional factor still remains, but then the fact that financially supporting my family again comes from the insurance over here. So, you know, but then in organizational sense, I might be losing some control. In a sense, say for example, I outsource. If you guys thought, like, heard of facilities management outsourcing, so basically proprietary versus contract employees, you are given outsourcing part of the contract to another company now, which might mean you lose a certain degree of control, but then that is for good, because understand, a maximum risk that I can take is also my risk appetite. So if I think there might be a protest or something which could affect me, I might want to think, okay, if this is affected, my production is affected so massively because of that, can I ensure that out? Or maybe a very simple example, my security guard on duty goes to sleep, and and few of the people who came down to my property maybe to purchase a place, and they see a guard sleeping. That's something but then the security guard is on someone else's payroll. I can tell the person, no, this is not happening correctly. Maybe I can, I can request for the change of personnel, and that person comes. So, this actually gives me it not entirely, hence reduction and transference come hand in hand, because transference doesn't entirely mean I get away with it. Reputational factor cannot be transferred. It's still, the brand value cannot be transferred off. But then maybe legal, financial, those impact to a certain extent can be transferred off. And we are always trying to absorb, accept as little as possible. Now, the whole idea of risk management is basically, as we said, identification of a risk. So where we know what is exactly what we are facing, then we think, okay, analysis, and we try to qualitatively and quantitatively analyze exactly what we are facing, what's the net outcome of it, and prioritization is criticality. So basically, say for example, if we think there are 20 risks which we have identified, now, one risk could be more critical. I'll take the example of, take the example of, let's think of very practical from real life, forget business. I'm riding down on a bike from my home to work. On a bike, my entire body is technically vulnerable in case of an accident, but I can think of riding the bike without a pair of gloves. But can I think of riding the bike without a helmet? Why not? Because I can probably, if my arm is affected to a great extent that it has to be removed operationally, if I lose an arm, but then I can still survive without an arm, but can I really survive without my head? So criticality is the understanding I can possibly not absolutely survive. In a business sense, is basically the understanding this is a function which is an absolute requirement for my show to go on. Now, if I'm a nightclub, I'll think, okay, if my music, my light, my DJ and all doesn't come, no matter how clean my floor is, nobody's still gonna visit my nightclub. So every business, every individual has a certain sense of that's where the analysis comes up, and where you see what's critical to you, what's absolutely essential for you to survive as an individual, as a business, and you see that and you prioritize, this is what we need to take the action on ASAP. Now, once you understand that, what's more important again is ownership. So you designate. Now, when I say a responsible entity, it doesn't necessarily mean one person, it could mean an entire team. So understanding that this has to be taken care of because see, without this, again, practical application would be very impossible. I understand everything, but I do not know how to do it. I have not been able to even designate the responsibility to someone else. Then there's no point. And then we see mitigating action plans, as we've seen in the last page. So basically, these were the mitigating action plans, the strategies. And next is, okay, we've analyzed risk, we have assigned responsible entities, applied mitigating actions, but then is that enough? One thing we've got to understand is risk is quite dynamic in nature. It basically changes from situation to situation. So, I mean, even in personal life, the risk that we faced as a kid in class 3 is not the same risk that we faced as a kid in class 6. And it's not the same risk that we face today. So risk changes, situations changes. If we switch from one city to another, the risk perception of that again changes. In business, the same thing happens. Maybe if I'm launching a new product, it'll again happen. If I'm having a new contract, changes. So we have to, so that monitoring needs to be there. If I make a document, and this is one of the biggest failures many organizations have actually suffered. I've gone across, audited, and I've seen there is a document which says, okay, even a crisis management manual is there, but then that manual was designed maybe 10 years ago. While I see the risk parameters to the business has changed, basically that manual is of no use. So as long as you do not continuously keep running this as a cycle, so you see any new parameters, and there could be things like, maybe I'm having a business, nothing changed, but the government changes, they come up with new policies, not in my control, right? Now that could still mean I might have to work out differently. So there could be situations which are not in our control, in life or in business, where we have to constantly check, define, and run this process. And this basically makes risk management a continuous process. It's basically never ending. It runs, it keeps going on and on. Now, we will talk of crisis management and contingency planning. Now, a crisis, when we think of, now, so far we're talking of risk management, we're thinking, okay, we try to observe everything. We try to, if we find anything, we try to mitigate, basically, in a common sense word, sort it out. Now, but then why is a crisis management plan required? Because, see, a risk is an outcome of uncertainty. And in a risk management program, we are always actively trying to foresee a risk. But then, like I said, we will always fail to foresee something. So that is where we are exposed to a crisis. And this leaves a possibility for a very special situation that maybe an individual or an organization is not even prepared for, no matter how proactive we think we are. So and we are in a situation of intense difficulty, and so that's exactly where um, a crisis management comes up as a picture. Because, see, a risk management plan in general aims to prevent crisis, because we're trying to observe, analyze, break down things, mitigate, take actions to cut down, if risk management plan goes perfectly the way it's aimed at, there should be no crisis technically. But then that's not practical. Something will always be. Even like we said, control measure wise, when we audit, you know in auditing also, the auditing may be incomplete. Typically, if we discuss auditing some other day in details, there are certain, in fact, we call of 3 categories of risk: the inherent, the control, and detection risk, wherein we basically talk of factors like certain steps would be inherently risky. Um, Certain steps wherein the control may have failed due to internal failures. Certain where detection may have failed. I, as an auditor, may not be able to see everything. Sometimes could be because I've not been able to observe. Sometimes could be because I've been given a wrong report, which I've failed to see. So even continuous auditing doesn't cover up everything. So, see, a contingency planning for special situations and doing them on the ground, which is absolutely essential. Otherwise, it just remains the book. practicing them on the ground through simulation exercises, both through maybe tabletop exercise, maybe an on-ground simulation exercise, limits us in terms of the possibility of having to react by adrenaline, by our fight or flight instinct. So we don't have to, like, if there's a fire, we don't have to run around thinking there's a fire. So basically, it's a combination of all those, and unexpected situations, they arise literally with dismaying regularities. They are more common than we think they are. And okay, we all are facing COVID-19. Come on, ask ourselves, no matter how well we thought we were planned, how many of us had actually planned that something like this can actually come up? So I think this is quite self-explanatory at this stage. This was a pandemic to the point we never planned of. Risk management, contingency planning, crisis management. Now, these are different terms, but they do go hand in hand. Risk analysis aids in identifying crisis scenarios. Indeed, how we do it, like I said before, analyzing historical data of own sites and the past, historical data from similar organizations. So maybe I'm running a hotel. Maybe, for example, I'm Marriott. Marriott, I'm launching a new Marriott hotel in Mumbai, where Marriott, assumingly, just for the sake of discussion, was never there. But then during my risk analysis, I'll certainly want to observe what has other hotels, maybe Hyatt, what has other hotels they've faced in the same geopolitical, socio-political environment. Information could be available from open source, and this could also mean from government databases also. So maybe crime rate in a certain area. And even if, say, for example, I'm going to purchase a house in a certain location of a certain city in a certain country, I would want to also understand maybe what's the crime rate over there, which could be available from past instances. But then historical study is never complete because there's always a first time. And it can happen. So some predictive analysis. So if I obviously walking down across a road and I find it's completely not occupied by any, it's blank, there is no illumination. I'm just talking of physical security threat and risk in this case. I will think, okay, there is a possibility of something happening to me someday, compared to if I go through a very busy road, well illuminated, with police patrol on the road. So, maybe I've not actually seen a statistical data, but this could be predictive also. So just because something has not happened before doesn't mean it may not. So we have to use that predictive sense. And that's where, again, the experience of a risk assessor comes up. So next, what we try to do is mitigate risks wherever feasible. So we try to, cut it down as much as we can. And, then we give the ownership of tasks, as we discussed before, appraising the entities of possible situations. We have a crisis communication structure because, see, as you see the picture over here on the slide, it's people shaking hands because crisis management is not a single person's cup of tea. It's always a conversation as a team. Now, if I have a fire in my place, no matter how well I'm used to handling fire, I would still have to call the fire engine. I'll call the fire brigade. I have to dial the number. I might have to call the ambulance also. So if and then when I'm practically doing it, I might have to take help of others to help out people coming down, recovering, from their situation. So that whole structure has to be identified and appraised, and then this needs to be conducted on a regular basis, once again, so as to ensure you do not react by adrenaline. Now, see, with organizations, the biggest factor to consider is having a crisis-ready structure is a top-down approach. So if I join an organization and I feel the CEO of the organization doesn't think this way about risk, then practically speaking, I will not be able to succeed. And that's sometime, we'll discuss, where matured organizations' perception of risk differs from immature organizations' perception of risk. To a certain degree, awareness programs work great in this because alerting people it indeed does create a huge difference. And trust me, many of you might be becoming HRs, and you could be observing this, at work. What I've noticed through practical experience conducting a crisis simulation, just consider a fire drill. I've gone to commercial properties to conduct a fire drill. I've gone to residential properties to conduct a fire drill. What I've noticed is a massive difference in the way people behaved in those drills. It's like in a commercial property, everything happens the way it should. People just come down, they assemble, everything goes fine. While in a residential property, those same people don't even come down. And through training, what I typically tell when I talk to either my colleagues or a wonderful opportunity that I've got over here is for people to understand this is exactly what awareness is all about. So people should not be participating in a drill because they'll be receiving a show cause letter from the HR department if they did not participate. If that is the perception towards like coming down and cooperating in a drill, then they'll never truly understand that this situation could happen at their home also. So it's more like, and this is a problem, through investigations experience when I've conducted workplace harassment investigations. I've noticed punitive action doesn't bring about much changes. So, talking about workplace harassment, see, most mature organizations will have something you call as a whistleblower helpline number. There's structure, everything is there. But often the victim of the situation will not even call for help simply out of the fear factor that they might lose their job in case they do complain. And that is indeed quite unfortunate. I've seen those faces, seen practicality, and I've noticed, hey, this is something you cannot really reach by a punitive action. So that's where awareness comes up. And this awareness, when brought top down, truly makes an organization crisis ready. Okay, there are a couple of points over here. When this typically came down from the fact of the fact that I've discussed this concept with many of my co-workers, colleagues, and these are certain of my experience which I thought I want to present this over here also. Often misunderstood. People think risk mitigation and contingency planning, they think it's the same, they think it's different. It's quite a few of misunderstood. People think, oh, risk mitigation, you talked of, okay, analyzing risk, doing this, mitigating. It's all proactive. While contingency is so reactive, no, it's not. It's not entirely true at all. So the difference is, so contingency planning basically is a plan which I have in advance also. So it's not reactive entirely. It's a plan which I have aimed at ensuring critical functions are operational, while risk mitigation aims at mitigating all risks, even the mundane ones we see every day. So, say, for example, water on the floor. It's a slip hazard. Someone can slip and fall, break their backbone. People can die also if they slip at the wrong angle. People can have a miscarriage. So, but typically when I say crisis, people think of fire, terrorism, active shooter. Nobody, so that's the point, is people don't consider these aspects. So risk management covers all these because risk management takes into account the even things like legal liability. So somebody slipping, and falling over and losing consciousness or breaking a bone, having a miscarriage, doesn't only mean human pain, which should certainly be the first step to prevent, but also a legal liability. What we typically would say is in this scenario would be a vicarious liability if they come to my property. But then contingency plan will not think of that. Contingency plan will think, okay, if there's a massive fire, or if there's a flood, if there's a protest, what's the core factor that the critical function. So say, for example, if I'm operating maybe a nightclub, the example that I took, okay, I could be happy if the welcoming light on the outside is not still uh, working entirely, maybe half working, but then the music is operational, the DJ is there, the lights, the flashing lights, and all are there. So I know that may be a critical function. It's a very vague, a vague example that I gave over here, just to explain a contingency plan tries to ensure the core things are operational. Now, risk mitigation strategies, by their very nature, resource investment in advance, while contingencies will have a budget identified. Now, okay, so imagine I have a branch of a certain bank where okay, employees come down, okay, uh, customers come down to that particular bank branch, and one day there's a fire, so I cannot operate the branch anymore. Now, a risk mitigation strategy would first tell me, okay, how important is a branch? And I know it's absolutely important. I need to have a branch. I can't really operate from home. So then I would think, okay, there are two ways of going. So if we ever discuss, business continuity, we'll talk of terms like hot sites, warm sites, and cold sites. It's basically nothing but having alternate offices, which are kind of ready. So if something happens at my place, I basically move into those and operate from there. But contingency, on the other hand, the idea is, okay, I have a contract with a hotel wherein their banquet is available for me. I may have the contract with 20 different hotels, and so if one is not available, the second is. So basically, I am not using my budget unless I actually need it. So the difference would be, say, for example, if I'm going for a meeting from A to B in a car, and I think there could be an engine failure, maybe blasting of a tire, and I cannot reach. And I think the meeting is important. It's really important. So what I do, is I think, okay, let me have a second vehicle with me, which drives down along with me. Now, in case something doesn't happen, then the cost that I spent on the second vehicle, which travels down with me, it's basically useless. While so if you see what happens in a contingency framework is, I've analyzed the same issue but reacted differently. So I might think, okay, this area I can have some hired car, maybe an Ola or Uber, and so in case something happens, I'll be booking those. So now coming down to the budget, yes, in the second case, in the contingency sense, also, I will keep a budget, something we call as a contingency reserve. If any of you move into project management, you'll come into this term very often, contingency reserve. So what we do is we restrict a certain part of the budget for that scenario, but we don't actively actually spend it out unless we see symptoms which are leading to we know, okay, this is a special scenario. Okay, I know my car engine has been making noise, or I know my driver says puncture tire, I don't have a stepney also. So I knew I came out well ahead of time. I have money, I have contacts for Uber. I said, okay, you change the tires, I'll book an Uber and go. So that's contingency plans. The money is only spent when I absolutely have to. It's kept in reserve though. So it's not entirely reactive. It is still proactive, while the difference is it is not employed unless absolutely required. So, but then what we got to understand is, so risk management, contingency planning, and crisis management actually go hand in hand. If we truly understand them, they are different by definitions, but then the interconnection of all of them actually creates a right frame of environment to operate in. And risk management is an evolving concept. Now, since we talked of risk, initially, to be very honest with you all, when I first came into this, risk management field, I thought like risk is a devil. The moment I heard risk, I thought of fire. I thought of, some crime. I thought of some terrorism, active shooter. But then risk is, like we discussed, it's a precondition for a change, for an innovation. and change is the only constant. So life and business would fail without innovation and change. We look at our own life or a business, every day things change. Literally, if I can say, there is some constant which is going to happen always, that is change. Things will change. Then, see, the perception of risk assessment has changed from time to time. Understanding of what can go wrong used to be the old concept of risk assessment. People used to think, when I am assessing risk, I'm thinking risk is wrong. So what can go wrong is assessing risk. Now, today it's understanding the likely outcomes of uncertain events. So what can happen, not necessarily what can go wrong. So it's like if I'm buying a lottery ticket, it's not necessarily I'm thinking, okay, I spent 10 rupees to buy the ticket. It's not necessarily, okay, what can go wrong? I lose 10 rupees. No, there's a possibility that I might end up winning, 1 lakh out of that 10 rupees also. So it's the balance, the consideration of both the plus and the minus, which is the correct way of thinking, which has changed as a perception these days. And there is no unique solution to risk mitigation. It depends on the risk appetite of the individual. It absolutely depends, you know, on the organization. Perception of risk management has changed from a discipline for controlling losses to a discipline for individuals, organizations' risk. So initially, it used to be risk management was all about controlling losses. But today, it's about controlling an organization's risk. So, it's not just about losses anymore. It's understanding the risks in general. In fact, ISO 31000 defines it as an effect of uncertainty in objectives. It doesn't talk about losses as an effect anymore. It doesn't talk about negative in general anymore. So I think I had taken a bit longer than I was supposed to take. Hello? Hello?
Yeah, hello.
Hello, ma'am.
So I would like to call upon Seher. She'll be asking you a few questions, which is there put up in the chat box because students had a lot of doubts in it. So,
Certainly.
Seher, over to you. You can start with the questions.
Sure.
Hello.
Hiya.
Hi. We've shortlisted a few questions that the students have asked you. So the first one is, what is the main difference between risk mitigation plan and a contingency plan?
Great. Say, it's actually a very good question. So a risk mitigation plan versus a contingency plan, the whole idea, the main difference is the way it's implemented. Say, so in a risk mitigation plan, so you are kind of being more proactive in terms of investment. It's not like contingency plan is reactive. It's reactive in terms of the investment. So both are preparations, whereas in risk mitigation, you are actually spending out. So like I gave the example, if I'm going from A to B in a meeting, and I have to think there is a possibility of a punctured tire or an engine breakdown, and I'm traveling down, then in a risk mitigation concept, I would possibly hire a second vehicle traveling down with me. So I'm already spending on the vehicle in advance. While in a contingency framework, I would consider that, keep that money that I would have to spend for Ola or Uber, but then I would keep it contact. But then I would not actually spend till the point I feel the necessity that I have to call for them. So that money, that budget, so that money is what we call as a contingency reserve, wherein I actually spend it when I see some symptoms. So a lot of people have this confusion. They think crisis. So okay, contingency plan is entirely reactive. No, the planning was still proactively done. It's only the budget investment, the actual application of the plan, which starts in risk mitigation. It's the entire application. The investment becomes like, say, for example, insurance is not a contingency investment. It's a risk mitigation. Whereas, if this particular example that I took in, this becomes a contingency scenario where I only spend when the situation arises. I hope I could illustrate.
Yes, sir. The next question we have is what is the process of risk management?
The only reason I avoid this because this can actually take ages. So risk management. So risk management, or you said, sorry, you said risk analysis or risk management process?
The risk management process.
So risk management process is so basically identifying risk in general. Like, once you know that, you consider the risk in terms of the business opportunity, the business goals that you're looking at. Then you give that responsibility to a risk owner. Once you've also prioritized that risk, so you give it to a risk owner, and then you keep practicing. So this was actually one of our slides, if you've noticed before. Let me just quickly see if I had failed to discuss this properly in this. So this slide was already there. Rather, I did not discuss on qualitative and quantitative risk assessment. Let me just quickly see if I can share the screen again. Is my screen visible?
Yes, sir.
Great. So, okay. So in general, first step is to understand, identify what the risk is. Second is to analyze, a combination of qualitative and quantitative. Then is to prioritize the risk in terms of criticality, which is the most important to attend, and level wise. So, okay, maybe this is the first one to solve, then the next one. And then to find out the responsible entity, the ownership of risk to be given to someone, which could be an individual entity or a group. It's usually a group. And we also try to establish a crisis communication structure. Obviously, that's the entire thing is covered over here in terms of the ownership. And then we find out the mitigating actions, which we discussed over here. So just give me a second. So that these are the mitigating actions: avoidance, acceptance, reduction, and transference. And the next step is to ensure if the controls are in place or not. So we constantly look for any new parameters. Are we prepared for those? Some parameters will be in our control voluntarily because maybe we've changed something in our personal life or in business, which has led to that change. Something could be not in our control, maybe a climatic change, maybe a change in governance, maybe a change in the regulations, which we are not in, not in our control. So that's what we notice. This as a cycle keeps going, and that's the whole overall, in a broader sense. That's the way a risk management program has to constantly operate, and it's a continuous process. Hello.
The next question we have is what should you tell the stakeholders and the public during a crisis? Like when you're facing a crisis, what can you tell them?
A brilliant question once again. So, okay. Now, so this, I have to answer this in, okay, from two sense. So when you say stakeholders or when you say public, because these two can mean very different questions. So what you say to a stakeholder is not what you say to a public necessarily, because you now, and also what's important is when you say what you say, your role in the organization also. So are you the CEO of the organization? Are you the risk manager of the organization? Are you the director of security for the organization? Because understand, as a risk manager or a director of security, you may understand risk, but you're not the owner of the risk, because so basically it's the people who've spent the money for the business, the actual, like, if I'm talking of Apple, and if one of you joins as the the security crisis, like, sorry, the CSO of Apple tomorrow, but then you may be the most important person to understand, in a sense, what risk to Apple could be like, but you still don't become the owner of a risk. So it's basically, when you're talking to a stakeholder, you are telling them the correct situation, what happens when it comes to the crowd or the public. So now there are three O's in crisis management, but then one of them is actually accepting ownership of the situation. But then, if so, I do not know from what designation, from what perspective are you talking of. So in a crisis management scenario, if you see, most mature organizations have a PR team, a team which deals with media communications. So they are specialized. So if you're talking from a crisis manager or a HR's perspective, I would say you simply do not talk to the public. But if you are an organization, you accept responsibility, you come up. And Coca-Cola has been a good example to this. So interestingly, there was this study, there was this problem that Coca-Cola had faced, wherein so this research, and that's one reason we say change, so risk is dynamic, because so what happened is Coca-Cola faced this issue when they said, okay, are you funding for spreading obesity? Because you're selling carbonated drinks, and that causes obesity. So initially what Coca-Cola did was they were funding a lot of research which were trying to disprove this medical research that, okay, soft drinks can cause obesity. Now, they were caught. So that's when, if you see, the CEO of Coca-Cola came up, told, no, what we will do is we will actually present you all our medical research every 6 months on the board. It was my mistake. No, he didn't actually say my mistake, but then he basically meant it that, no, see, what happened has happened, but from tomorrow, what we'll try to do is basically work on things like maybe water, maybe Coke Zero, Diet Coke, and all that. So now, if you see, he accepted ownership, he accepted what had happened, and he also said, yes, I'm proceeding forward. So that should be the approach to the public. But then, once again, if the question comes up, who should talk to the public, it should actually be only the entity who's been given this consent. And that's typically done for a reason, because typically what happens is, when we represent an organization, if you're not trained in how to interact with the media, what happens is, now, say, for example, if you work with a company like Coca-Cola, no matter which designation you work for, when you talk to the press, the newspaper is going to write like, Coca-Cola representative so-and-so has said this. So it's not basically you talking, it's Coca-Cola talking. Coca-Cola is just an example over here. But then, so that's the reason it's a respected, it's a department that's been trained to do this. They interact while, but then overall, it's, presenting the correct scenario. It's coming up with the right concept, accepting ownership, and telling the truth, which typically has helped organizations in the past. And Coca-Cola was just one example.
Another question we have is, how often does a company need to refresh its assessment of its top risks? And are there any effective crisis management simulation exercises that they can go for?
Sorry, did you say stock risk? Sorry, I can get your question. Can you just
I'll repeat that.
Yeah.
How often does a company need to refresh its assessment of the top risks? And are there any effective crisis management simulation exercises that they can go in for?
Great. Say top risk. You say top risk, right? Top risk.
Yes, sir.
Great. Sorry, ma'am. I couldn't hear you clearly. So, okay. So now, okay. So see, the point is, so these days, that's again, when we think of, we have risk management evolving, and we have it as a continuous process. So it would be technically wrong for me to say it should be 6 years, 6 months, 3 months. No, it's actually an everyday process. If you see today, we are having ERM working in conjunction with ERP. So ERP is the enterprise resource planning. ERM is the enterprise risk management. Now they work in conjunction already. We have a concept called GRC. That's what we call as a governance, risk, and compliance working together. So now, if you talk of in terms of government regulation for a crisis management drill, maybe in Mumbai, I would say, okay, you should have a fire drill 6 months. But then that doesn't mean a risk management program should be conducted at so and so intervals. No, it's basically a sort of a PDCA structure, a plan, do, check, and act. So if you come up with something new, there has to be a planning and then checking and acting according to that. Also, I could think of a Six Sigma approach to that, like you say in DMAIC, define, measure, analyze, improve, and control. And if you see, again, it's a continuous process. It would be wrong for me to correctly predict a frequency in which it should be done. It may depend on experience of yours, but to be logically stating it for an answer's sake over here, it should be a continuous monitoring, which is day to day. And I could say it should be every minute when everything happens. There should be, so basically this is where reporting of day-to-day scenarios come up. And again, reporting again becomes perfect where awareness programs come up. So people might be noticing something, completely thinking, oh, this is too nascent, forget it. They can not require junior stage, forget it. Now, so this is where awareness combined with reporting structure, combined with governance, which brings control at the end of the day. So this I cannot give you an interval which is correct in an academic sense. There's no nothing that I can think of which is most correct. No.
The last question we have for this session is: if you make a wrong decision during the cyber breach, what are the legal ramifications faced?
So, ma'am, my question is, who's the you?
You would be the company or whoever is managing the risks.
Okay. Okay. No, because that's a very important question, because you as in me is one thing, and you as in the owner of the company concerned is a very different thing. So, okay. So, no. So it depends, practically speaking, it depends on the nature of risk that you're talking of. Now, and sometimes, a very basic thing, like say, for example, I go to a mall with my pregnant wife, and she has slipped because there was water on the floor, and there is a unfortunately lose my baby. I can say the mall, that's something we call as a duty of care, and I can tell it as a vicarious liability. I can try to sue the mall also. Now, to what extent this can go wrong, and I'm just stating it for discussion's sake that it can go wrong. That's very difficult to predict because it will depend from situation to situation. Because now, risk, like I said, risk management is such a wide concept. Now, if I talk on insurance, it's a risk, it's a very wide concept. We're only right now we're discussing security and EHS, while we talked of certain risk in terms of enterprise risk management. We talked of personal risk, but then there are so many risks when you split them down, and I could not honestly, I cannot really finish them. In fact, if I talk on every aspect of risk, I'll probably take 1 hour each to just even give a brief basic description of each. So it's to exactly, now if you ask me to say quantify what's the extent you could be sued to, it's very difficult because it depends from parameter to parameter. We cannot say that exactly to what extent, because that depends completely on what specific scenario are you talking of. So I do not know. unless I'm failing to understand, or if I have understood correctly, it is almost impossible to define exactly what's the extent I could be facing a legal implication. But yes, there are certain terms I could think of: duty of care, torts law, vicarious liabilities are terms I would think of when I think of legal implications in these scenarios.
Thank you, sir. I request Farhad ma'am to propose the vote of thanks.
Hello, very good afternoon. Hello,
Good afternoon, ma'am.
and you can hear me, no?
Yes.
Good afternoon, ma'am.
Okay, very good afternoon. I'm Dr. Farhad from Assistant Professor Pillai College of Arts, Commerce and Science. I would thank Jeet Mukherjee sir for giving a wonderful session. I would thank my management, my principal, Dr. Gajanan Bader, my vice principal, Mrs. Deepika Sharma, my coordinator, Nitya Varghese, and in charge of Management Association, Sharavati ma'am. Sir, thank you very much for coming and making this session a very wonderful and interesting. Thank you, sir. Thank you.
Much regards to you, actually, for giving me this opportunity to be able to speak over here, ma'am. Thank you so much, ma'am.
Thank you very much, Jeet, to join in. Thank you
Thank you,
all of
Nitya,
you.
ma'am.
Nishant, we are done. I think we can wind up.